Welcome, everyone. I hope you're all having a great weekend. Hopefully, you're enjoying your Friday and Saturday and spending time with family or friends. I wanted to just jump on, and I actually had something prepared. This is just some thoughts on a subject that I don't really feel, it doesn't feel like it would fit into an episode on the normal channel, so this is just going to be an exclusive. But I did have some thoughts prepared, and this is more of like just me thinking about the past couple years investing, sharing some thoughts on it and some insights of some things that I've read that have made me come to some realizations over the past few months. And that is one of the main ones I want to touch on is investing is very complex. There's a ton of things that you can learn about it. People can literally spend their entire adult life studying investing. And even when they're a kid, they can start studying it. And you can never become perfect at it, right? Even the great ones like Warren Buffett make mistakes. So investing is incredibly complex, but one of the things I think needs to be emphasized is because it's complex doesn't mean we need to make it more complex than it is. And sometimes some of the best decisions are made off of the most simple, easy to understand, explain it, like it's to a child type of information. In fact, I think in some cases, the more deep you dive into a company, the more complex you get with it, the more your knowledge expands on an investment, the more likely you are to make poor investment decisions. Poor decisions, not good ones. And sometimes just some surface level knowledge on companies, surface level decisions based off of very basic, easy to understand and easy to explain logic leads to better outcomes. That's the whole theme of what I want to talk about. So there's some other subjects I want to talk about as well. I think that right now, investing is in an interesting territory, especially for people, you're viewing all this content on YouTube. I'm a YouTuber making content. I've done this for 2.5 years, and I've seen the landscape change over time to where investing has become very exciting. There's new videos with flames in the background and people making shocked faces, and everything is extreme, black and white, Everything's dialed to 10. In order to compete on YouTube, you have to be very clickbaity. You have to be shocking. You have to get people to click on your video over the next one that's very shocking. So I've seen some dynamic changes, and I want to touch on that as well. So we're going to cover a couple topics here. The first one I'll go into is a more simple one, which is the changes in dynamic I've seen on YouTube and social media with investing over the past couple of years. I started my channel in February of 2019. It was very simple. I had laid out what I thought was a good investment plan, which was everything that I studied showed that one of the most solid, defensive, and well-performing, in fact, it usually outperforms the market over long stretches of time, was to identify companies that have extremely good products, services, diversified brands. They're blue chip companies. Usually they're paying passive income. They're paying dividends. They've been steadily raising their dividends over the course of a long period of time, and they're very established businesses. And by blue chip, I mean companies that can weather bad environments. When the economy goes through its up and downs, when things happen, these companies can survive. Those are the type of companies that I sought out to invest in. And for the most part, sorry, I have allergies. For the most part, that's what my portfolio was. It was a lot of blue chip companies. I invested in companies like Home Depot and Costco, Coca-Cola, Pepsi, these type of companies. And I did that for the first couple of years. And at the time, investing on social media wasn't such a extreme thing. Now it's turned into an extreme thing. Ever since 2020 happened, Robinhood had like 10 million retail investors sign up over a weekend. Wall Street Bets. I've been subscriber of Wall Street Bets for literally years. So I've been a subscriber, I think, since like 2017. And it was a very unique niche culture where people just, they called each other dummies and idiots and whatnot, and they would do really stupid trades. But it was a small group of people, and now it's completely mainstream. It grew from a couple 100,000 subscribers to over 10 million in 1 year. That's how much Wall Street Bets grew, from a couple 100,000 to over 10 million in like a 1.5 year stretch. So investing has gone from a place where when I was first doing my videos for the first couple of years, I could just make content about dividend investing, creating a portfolio, having the principles and basics of it. And that was mostly the knowledge base and skill level of people at the time. Now, many people are creating content about it. There's a lot more people that are aware of investing. A lot more people have Robinhood and other things, Webull and whatnot. And there's always something exciting going on, whether it's the new IPO or the new SPAC or the new crypto or the whatever industry is popping next, right? This is investing now. There's constant distractions, constant things going on, constant red lights and things trying to grab your attention. And the landscape has changed. But the message that I want to share with this is I think you'll still have the best results by sticking to what's been proven for the past 50 to 100 years, which is investing in high quality productive assets that continue to compound their wealth and compound their growth and their revenue and their earnings over decades to come. And that is what I plan on doing. I am not changing my channel. I'm not changing my content to fit in with the mold of the next 6 months, whatever's popular for the next 6 months. I've seen investors go from investing in solid blue chip companies and dividend companies to now they're 100% crypto channels. That's all they talk about. I've seen investors that went from doing real good in-depth due diligence on companies and really doing analysis that I think was good security level analysis on holdings and valuation to now every stock is 100. What's the next 10,000% return, right? What's the next one that we can just get to pop? And hopefully that one will do well. Things have changed to become more competitive on the social media landscape, I think largely in a negative way. Some positives about it. I don't think it's all bad, but I think there are definitely some negatives because everything has become almost, I would say that finance on YouTube and Twitter is moving almost to like the checkout aisle where you see the tabloids, the magazines there, like the People magazine and whatnot. I don't even know the names of them, but they just have ridiculous clickbait on it's not clickbait, but it's buy this magazine bait because to see the next 10 secrets of this or whatever. It's kind of moved to YouTube. That same type of shock value garbage, a lot of it has moved to YouTube, is what I've noticed. What I'm going to commit to you in this video, and what I've already committed many times, is that's not where my channel's going. I'm not changing to mold into that. I don't care if I don't get as many clicks as other YouTubers. I'm going to continue to follow what I think has the highest likelihood and the highest probability of leading my followers to have wealth and to grow wealth over time. So that's the first thing, is I don't plan on shifting my content around to fit whatever is garnering the most clicks. That's not my plan. That's not what I intend to do. And I think that it's easy to get lost into that. One thing I want to point out, from a creator's perspective, the ones making videos, 100 videos on Palantir, right? They don't care. It doesn't matter to them whether Palantir becomes $1 trillion company or a $0 company. It does not matter. They're getting paid for every video they make. And what they're seeing is when I put Palantir on a thumbnail, I'm going to get a lot of clicks, which puts money in my pocket. Then I can invest in whatever I want, right? There's channels entirely dedicated to Tesla. That's their brand. And they're incentivized to only make bullish content about Tesla because that's their job. It's their livelihood. So look at people's incentive when they're making nonstop content about stuff that's probably not the best investments. And I'm not bashing Palantir or Tesla. They may or may not be good investments. This has nothing to do with those stocks in particular. What I'm pointing out is that when content creators are making nonstop content about different holdings, specifically because they get a lot of clicks on those content, and you can tell because they're the same companies that everybody makes content around, they are incentivized to do that, and the content creator is going to get wealthy either way, whether or not those companies do well or do bad. I don't create content around companies because I think it's going to be good for clicks. I clearly don't do that because a lot of the companies I create content around, nobody else is even talking about them. They're not ones that anybody else is interested in. I've made a lot of videos about, if I look at my top holdings, the ones that I've been the most bullish about for the last year, one of them is Disney. That's one company that I just think is such a good company to own. I think people will benefit from having this in the portfolio for the next 10 years. It's not some crazy cool company that makes software that helps track down terrorists, right? Everybody knows about Disney. but I see the economics of their streaming service, Disney Plus. I see the brand value and all the companies they own, like Marvel, and all the brands that they own. And I think that there's extremely low chance of losing money with this company and a very good chance of making a lot of money over the next 10 years. So this is a company that I talked a lot about, has nothing to do with me thinking I'm going to get a lot of clicks whenever I do a Disney video. In fact, from what I can tell, I don't get any extra clicks for talking about Disney. It's about the same as every other episode I do. The same thing talking about companies like Costco. It's a very boring company, not one that people are excited about. Nothing's new about it. But I make content around these type of companies regardless, and that's the point. I'm making content around things that I actually think are going to make people money. I've invested more into Apple and more into Microsoft. I've explained why I think these are good investments. It has nothing to do with me thinking that I'm going to get extra attention or engagement or anything by talking about these two companies. The reason that I'm talking about them is because I think they'll make people wealthy that invest in them over the next 10 years. I think they'll grow their wealth. So that's one commitment I just wanted to point out. As things are changing on YouTube, they're changing on social media. It's becoming much more productized, much more flashy, impulsive. Everything changes every 3 months. People completely change what they're talking about. I don't plan on doing that. I plan on sticking to the same strategy. Now, moving on from that, changing subjects, I need to talk about, well, I don't need to, but I want to talk about this presentation. And this shifts with another thing that I was talking about earlier, which is I've seen instances, and I'm trying to prevent myself from doing this and prevent anybody else from doing this, which is you don't have to be a genius. And this is one of the best things that Peter Lynch says. You don't have to be good at math to be a great investor. You don't have to know, you just have to be able to add two numbers together. You can be a good investor. And Peter Lynch has stressed over and over again that a lot of the best investment decisions are made by the most simple logic ever. Just the most simple, straightforward logic ever. That's what comes to just the things that you can explain to children often lead to the best investments. And I've seen ample examples of this in my own portfolio. If we go back to the passive income fund here, if I look at my holdings here, which ones have performed so well, right? Apple, JP Morgan, Disney, Microsoft, Costco, right? Home Depot, Texas Roadhouse, these have all done fantastic. In fact, some of the best performing investments in my portfolio, most of them are very simple, easy to understand companies, ones that everybody recognizes. There's nothing special about these companies. And my investment thesis on them is very simple. So that's the one thing I wanted to point out is Peter Lynch has repeatedly said that investing doesn't need to be complicated, doesn't need to be difficult. And a lot of times the most simple decisions lead to the best outcome. This hedge fund, it's called Tollymore. And I think it's a London-based hedge fund, but they do this write-up. I'm just going to look at a couple pages of this because I was reading through it and I think it's very interesting. And they hit on this point a lot. They hit on it from an academic point of view. So they say they talk about behavioral issues here. So this is like psychology, right? Let's get into this here. Let me try to find. It's not supposed to be easy. Anybody who finds it easy is stupid. Quote from Charlie Munger. This is some statistics about investing and how difficult it is to actually beat a comparable benchmark. Like people talk about, my story fund, when I was outperforming SPY, it's so easy. All you do is invest in tech. Now it's not outperforming. Now it's difficult to beat SPY. A lot of people that picked the hot companies last year that were beating SPY aren't doing so anymore. So this explains how difficult it is to beat an index. They say active trading harms aggregate investment results. So Journal of Finance. Over the last 15 years, only 1 in 13 large cap managers, only 1 in 19 mid cap managers, and only 1 in 23 small cap managers were able to outperform their benchmark index. Staggering right there. How few professionals are able to outperform a benchmark index. Investors underperform both passive and active funds in which they are invested. That's Morningstar survey. Morningstar does a lot of surveys and most investors do not outperform indexes. A framework to stay the course in periods of self-doubt. This is just them kind of reflecting, and I like reading these thoughts. We know investing is hard. We are here because we think we can make a difference. Spending time with reflecting, thoughtful, and talented peers can lead to imposter syndrome. We need a broader context in which to judge our prospects for long-term success. He talks about how he has sell-side experience, exposed me to the incentives and actions of an institutional money manager industry. This is an introduction. It gets really good in a minute here. The following is a collection of 8 observations from that experience. For each behavioral constraint, I'll discuss my personal impressions as well as the outside view, why this may be antithetical to the sound of investing practice, and how we can set ourselves up to avoid and exploit these behavioral errors. So he's basically saying that if you understand where investors fall short and the behavioral aspects about humans in general that make it so that we're bad at investing, if you understand that, it's easier to overcome them. Observation. Corporate access perceived as a source of edge for largest managers. Corporate access-led investment process. Large, complex financial models, broad knowledge versus deep understanding, lack of calibration of investment processes to forecasting errors. Peter Lynch talks about this, how corporate access in these big companies like, BlackRock and whatnot, these huge hedge fund managers, often the argument goes, you're never going to outperform them. They got access to like 1 million teams and analysts and whatnot. Not true. Peter Lynch outperformed them for 13 years, and he's one guy. And he said that it's easy to outperform him because all you have to do is have an edge on a certain industry. You just make better investment decisions. It's not as difficult as it sounds. They don't always have the advantage, and then it explains right here why a lot of times bigger institutions actually have a disadvantage. What's the problem? Information gathering increases confidence, but not accuracy. This is what I was talking about to begin with, where if you dive way too deep into a company and you research a company, sometimes that can increase your information gathering. You have more info about the company, but not your accuracy. So you're not more likely to be correct about that company. They also highlight, this is less relevant to us, exposure to sales pitches. I guess that's relevant because you can get exposed to a sales pitch of a company. Misdirected intellectual effort and intellectual dishonesty. Now, this is a part that I think is worth paying attention to. The outside view. Overconfidence can have profound consequences, inflating investors' valuation of their investments. So if you're overconfident in your own investments, if you've done so much research on them that you feel like you know everything inside and out of a company to the point where you're just very confident on this investment, it can lead you to having an inflated valuation of your company. And you have to ask yourself that. Have I done so much research on this that I just feel like it has to be worth more than what it actually is? Have I done so much analysis on Netflix and Disney that I think these companies are worth more than they are? Have I done so much analysis on Apple that I think that Apple is worth more than what it actually is? Those are questions you have to ask yourself. Those are holdings that I'm bullish on. I consider those questions with myself. Think about the companies that you're bullish on, that you've done research on, and ask yourself if you might have done so much research on it that you think you might be attributing too much to this company, too much value to it. They say leading physicians, this is something that's not just happening in the investment world. They say leading physicians to gravitate too quickly to a diagnosis and making people intolerant of dissenting views. So if I ever get to the point where I don't even want to listen to someone's argument against a company that I'm invested in, that's not a point that you should be at. And that is where a lot of people get with good companies. They've done so much research on Tesla. They know everything, and you haven't done as much research, and you haven't done as much research. I know more about you than Tesla, on Tesla, right? So even if you come with a counter argument about Tesla, I don't even want to hear it because I know more about Tesla than you. I don't even want to hear your argument. You don't know anything about it. I've done more research, and your concerns about the valuation, your concerns about the competition, I've done the research. They can't compete. I know more. That's the attitude a lot of people have, especially with cult-like companies, right? Everybody, I think, that does investments and they're excited about a company you're invested in, I think it's a normal human behavior to do this. And obviously, again, it's not just investing. They have examples with physicians that are too quick to diagnose somebody with something that they probably studied and learned about. Also, it makes you intolerant of any type of dissenting views, so you're not open to criticism. So I know that people, I know when somebody is completely incapable of hearing criticisms of their investment, that they're not a great investor. And I'm just being totally blunt here. If I even raise a question about a different company or a different investment, if I raise any type of surface level criticism like, hey, I think the valuation might be a little bit off here or whatnot, and somebody just attacks me for it, like they can't stand that somebody was slightly questioning their investment, I know right off the bat they're not a good investor because they are intolerant of any dissenting views. They're incapable of looking at the other side and even observing someone else's opinion. So that's something that they say is overconfidence can have profound consequences, inflating investors' valuation of their own investments. Numerous studies, right? This isn't something that this hedge fund is just saying. They're saying numerous studies suggest that confidence and accuracy are not highly related. You can be extremely confident about your investment. That doesn't make you right. College football experts were asked to predict game outcomes, organizational behavior, and human decision processes. Professional horse handicappers predicting horse races, Paul Slovic. In subsequent rounds of the game, the experts were given additional information and asked to rank their confidence. The additional information did not improve the accuracy of their predictions, but did increase their confidence of their bets. So although they became confident, they weren't any more accurate than anybody else guessing. The problem with this is it relates to investing is that the extra confidence causes us to increase the size of our bets without the corresponding increase in our capacity to predict the outcomes, causing us to lose money. Meaning, you might become so confident in investment because you spent the time, you've done the due diligence, you've done the work, that you put more and more money into this investment and the outcome might not be what you predicted and you end up losing a lot of money, an outsized amount of money because you put such a heavy bet on it. I have an example of somebody that did this that I'm going to show in a minute. In fact, I'll show that right now because it plugs in so good. I want to read this part again just to emphasize it. The problem with this as it relates to investing is that the extra confidence from studying an investment, from doing due diligence on it like crazy, can cause you to increase your size of your bets without the corresponding increase in the capacity to predict the outcome, causing you to lose a lot of money. Let me go to the example here. I'm not trying to he's actually acknowledged the mistakes he's made, but this is somebody I want to highlight on Twitter. His name's Richard Chu. He has 63,000 followers on Twitter. So he has a big group following him. That's a huge following for financial Twitter, right? I know I have like 200,000 and 210,000 on YouTube, but this is a lot for Twitter. This person, just to give some background, did incredibly in-depth research on the healthcare disruptive technology industry. He, 7 months ago, invested 40% of his portfolio into Teladoc, okay? And he knew everything about Teladoc. He knew the managers, the executive team on he knew their first and last name of every executive. He knew all the deals that they were doing. He thought that there's going to be synergy with Teladoc and other things. He knew all the potential deals and he knew everything about the company. Richard became extraordinarily confident with his investment, where he was willing to put 40% of his portfolio into one small company called Teladoc, right? And for a certain time, it was going up. It was an ARK Invest, Cathie Wood type of thing. It was going up. And then more recently, things have changed. Now, let me find the post here. He talks about his experience and what happened. He has 40% of his money in Teladoc. And then let me go to the Teladoc. Let's take a look at the performance here. This is over the past year. This is when he was buying it. He thought that things were changing for the company, and he was buying it, all throughout here. And then Teladoc from its highs has dropped 50%. So this is a company that he knew everything about. He knew the ins and outs of this company. He knew all the research on it. He did all the work on it. And then things didn't work out. This is his post that he put after realizing his mistake and reassessing his investment decisions. He says, many of my mistakes have been being too early to a story. Although you can earn much higher returns by seeing potential before the market does and being right, the vast majority of great stories don't turn out to be successful investments. Proof of execution is critical. He says, now this is much easier said than done, especially when I'm investing in young companies that are still early in the stages of market adoption. Where's the sweet spot? Where is there enough proof that your thesis is achievable without it being a consensus to fully priced in? And do you have enough margin of safety where you don't lose too much even if your thesis doesn't play out as you hoped? Of course, the earlier you are, the harder it is to get it right because the distribution of possible outcomes is wider. He addresses Teladoc and how wrong he was on this bet and how much money. Well, he doesn't say the total amount he lost, but he lost a lot of money with Teladoc. While Teladoc and LVGO both had a good track record, my thesis relied on them outperforming cross-selling synergy targets and the successful integration of Levingo or whatever it is, both of which had not occurred. They had all the ingredients, but I needed to believe in their ability to execute. I had read a ton of materials that led me to envision what the future of healthcare should be. It was clear that Jason, Glenn, and Hemant shared my vision from past interviews and earnings calls where they made the right acquisitions to get there, so I felt comfortable projecting. While they may still realize my original vision, I'm definitely hoping they do. Recent data made it clear that I am underestimating the execution risk required to get there. Other more spec ideas like these two also had the right ingredients but needed to show execution. Investing is all about thinking in bets. My goal is to find those investments that have a high probability of working out based on the data I have today, but data changes. We can't control what happens, but we can control how we react to it. I found that successful investments tend to be the ones where I've had an easy to explain thesis tracked by a few key metrics that tell me if the thesis is playing out, and I didn't overpay relative to what was likely to happen. His last tweet here on this subject is absolutely key. He says, I found out that my most successful investments, noting that he's lost a ton of money on Teladoc, right? His most successful investments have been easy to explain. Like Peter Lynch says, they have to be easy to explain investments, tracked by a few key factors that tell me if my thesis is playing out, and I don't overpay relative to the opportunity. Now, the reason that I highlight Richard here is because he's an example of somebody that I think falls under this type of trap of keep making investing more complicated than it is. If we look at investing through simple terms, investing in companies, looking at a few metrics to gauge their valuation, and then investing in companies that you think have a good likelihood of compounding, of building and growing over the next decade, I think you'll have much better results than doing what Richard did. And obviously going so in depth to one company that you know the ins and outs of it, that you aren't even thinking about anything else. You're not even considering anything else. And you have a super inflated estimation of what your companies are worth. So he definitely falls under this category of being overconfident in his investment, and that didn't increase his accuracy. Teladoc has not worked out so far. Now, I do need to highlight, let me log into M1 Finance here, because I need to point this out. He's not the only one to invest in Teladoc. Teladoc is a popular company, right? If I go to my portfolio, I have Teladoc, I still hold it. The difference is not putting 40% of your portfolio on it. When I lost 50% in Teladoc, I lost $576. Teladoc was a small portion of my portfolio. And I think that that's why you size your bets accordingly. You make it so that your list of holdings that you're invested in is a little bit more flat than making it so heavily weighted towards a couple companies. And if you do weight it towards those couple companies, you have to be right. You have to be right. There's no room for error. There's no room for getting it wrong. You have to have an incredibly good margin of safety very low likelihood of losing money. Teladoc, I do not think, fell in that category. I think that Teladoc was an incredibly risky holding for him to have as 40% of his portfolio. So it's okay to have companies not work out the way that you want them to, as long as you're sizing the bets appropriately, making it so that your portfolio at the end of the day has a lot of different bets. And if you're buying all these companies for decent valuations, you'll make money in the end. But I just wanted to point that out. I do own Teladoc as well. I'm not blaming Richard, but portfolio diversification and the weighting is very important. Now, this goes on further, highlighting this type of phenomenon of having too many things, making it too complicated can lead to worse outcomes. For instance, this highlights that overloading our cognitive capacity with more information can actually lead to worse decision making. In one study, 60% of participants chose the objectively best car when given 4 attributes versus a 20% success rate when given 12 attributes. So they asked people what's objectively the best vehicle. They gave a group of them 4 attributes and a group of them 12. And the ones that had 4 attributes, the simpler group of data, they chose the more objectively better car at a much higher percentage, right? That's what that study outlines. So a lot of times simple information is very good. This goes on explaining this type of phenomenon as well as other behavioral problems. But that's what I wanted to highlight. When I'm looking at my portfolio and I'm looking at the companies that I'm investing in, I'm trying to follow that type of thought process that Peter Lynch was adamant about. Investing in simple companies that people use on a daily basis with simple products that are highly relevant at a reasonable price. That is, I think, the best way to invest. I invest in Google because people use their products every single day, hours a day. They're on YouTube for hours a day. They're on Google. They're using Gmail. Everybody's using their products every day, and their revenue's growing like crazy. I look at the charts all the time at different companies. Like I can go here, I can look at Google, and I can see that the company's growing. So not only is this a company that has simple products that people use on a daily basis, but they're also growing. So I know I'm not investing in a company that's just stagnating or declining. The same thing with Netflix. I get criticism about Netflix all the time about this investment. And I got a lot of pushback when I made this investment, especially because so far I'm in the red on it, which I'm totally okay with. But this is another example of a company that for 10 years, I've been a subscriber to it. Every single month, paying them every month for 10 years. There's not that many companies that I've been subscribed to for that long, and I have no intention of leaving it in the future. Netflix is a company that people use on average, I think, 2.5 hours a day is the average watch time for a Netflix user. An incredible amount of engagement. And it's one that I see used every single day. It's ubiquitous in people's lives. It's one of the default streaming services. But regardless, people got hung up on different attributes about it, the free cash flow, this metrics, how their balance sheet works, how their income statement works, things that I think are overcomplicating an investment. This is a simple product that people use every single day. They're growing their subscribers every single quarter, and it's a business that I want to own. Recently, I was sent this by someone, which is, it's a little piece of a letter from Sequoia Capital, which Sequoia Capital is a legendary hedge fund that has had annualized returns of about 13.5% for the past 50 years. So vastly outperforming the broader market for 50 years. This is the 2 investments that they highlighted that they're extra bullish on right now. And you might notice these 2 investments because yours truly has been talking about them for a long time. Disney and Netflix are both bets on global trend towards subscription-based streaming video consumption, which we think is still in its early innings, as people increasingly watch their TV and movies via apps instead of cable bundles. We expect a relatively egalitarian media ecosystem that historically supported many winners to become much more elitist. The streaming model heavily favors scaled early movers. That's something that I've been trying to explain for a long time. Netflix has a huge advantage because the longer you have a subscription-based company, the longer you have had it, the lower the churn. Because you have a huge base audience there that's very unlikely to churn. Every passing month, they're less likely to churn than the month before. So Netflix has a huge advantage over all the new streaming companies. That's what they say when they say the streaming model heavily favors scaled early movers. Netflix is a scaled early mover who benefit from a virtuous cycle in which massive content investment attracts incremental subscribers and revenues, which enable further content investment, which yields still more subscriber growth. I've gone through this virtuous cycle many times on the channel. I hope you guys are familiar with it by now. Netflix and Disney are investing heavily to drive this virtuous cycle, which is depressing their current profits. Again, people dive into the companies and they've argued that Disney is not a buy because they're not generating enough cash, yada, 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 blah, blah, blah. I've heard this all before. This is not keeping it simple. When you get way too into the nitty gritty of companies, a lot of times it can make you keep out of really obviously good investments of products and services people are using on a daily basis. They say, which is depressing their current profits, but people can only watch so much TV and wrap their arms around so much selection, which means that the growth of programming spend will eventually have to slow. If the world's two most compelling collections of streamed video content continue to attract incremental subscriber amidst the moderating pace of investment, then content cost per subscriber will begin to fall, widening competitive gaps that are already very substantial by layering a cost advantage on top of a product quality advantage. As a result of this dynamic, which we think competitors will struggle to replicate, we believe that the leaders of the video entertainment industry's streaming era will be far larger and more profitable than those of the cable era. I've been saying this again. I think Netflix is going to be one of the most profitable businesses over the next 10 years. I truly believe that. Unless they fail with their mission of continuing to grow. If they keep growing like they are, the world is enormous. They will grow far past 200 million subscribers, and their content costs will not keep up. And they'll get to a point of massive amounts of free cash flow. So they say, they'll be far more profitable than those of the cable era. I think that's obviously true. While this possibility is by no means lost on the stock market, we invested in Disney and Netflix because we believe the prices still fail to discount the degree to which we expect a small handful of victors to take most of the streaming era's significantly greater spoils. I've been saying this again for a long time, that there's a lot of streaming services and it makes people very bearish on Netflix and Disney right now. You have, the list. You have Discovery, Warner Media, Star, Paramount, so on and so forth. You have all of these. They're not all going to be big winners. Not all of these are going to be massive winners, and they're not all going to take away. There's going to be a few winners, and I think it's most likely that Disney and Netflix will be the top two. That's my bet. Now Sequoia Capital, one of the most successful funds ever throughout history, throughout the last 50 years, is coming to that conclusion as well. So I wanted to highlight that. I invest in companies like Netflix. I've changed the dynamic of my portfolio a little bit more to focus on these type of simple products, where I look at companies like Google. Everybody uses them every day. Amazon, you're on Amazon every day using Amazon Prime, Music, their 2-day shipping, all of that. Apple, the same thing. Facebook, Microsoft, Adobe, Netflix. Does anybody not know about these companies? Everybody knows about them. These are what I make my portfolio out of. PayPal, Salesforce is one of the ones that's less ubiquitous, but I know it. I'm very familiar with the company. I've worked in the industry. Twilio is another one that creates the backboard of modern messaging. Atlassian, people use this one every single day. Developers rely on these tools. And then you have Disney. But Netflix and Disney are two that I have bets on for a long time. So far, I'm in the green with Disney. So people say I have some credibility there with Disney because I'm in the green on it with the passive income account. If I go to it right here, I feel just as strongly that Netflix will be a successful investment. So even though I'm in the green by $4,000 on Disney, I think that I'll end up making money on Netflix. In my opinion, it's only a matter of time. Now, there's no guarantees. If Netflix fails and they don't come out with any good content or something, right? They don't have any type of series or anything that hits over the next 2 years, then we have a problem. But if they keep executing, and they have such a big advantage right now that even if they execute just moderately well, I'm not hoping for them to do anything spectacular. I really think that Netflix will be one of the most successful. I think I'll be well in the green with this holding over time. So that's my overall thoughts. I could go through all these companies, but I just wanted to share some thoughts on investing. Don't get wrapped up too much into all the nitty gritty details. A lot of people spend way too much time looking into every single detail of a holding, and many times the best investment decisions are really the ones that are the most simple. Just looking at companies and products that you use, learning how to do valuation on them where you know that you're getting at least a reasonable valuation on them, you're not overpaying to a huge extent, and then buying companies that you think have a very long-term growth path. If I look at companies that I own, I think that Apple is halfway through its growth story. I really do. I think it's a mature company, but it's creating such a big moat. It has so many products and services that people use every single day. Most users are not even considering leaving Apple's ecosystem. Same thing with JP Morgan. Been around for a very long time. It knows all the competitors. I think it will continue to be around for a long time. Disney, Microsoft, Costco. These are companies that are boring, but they fit that long growth, that super long growth path. So that's what I've been doing with my portfolio, is trying to keep things simple, investing in what I think are high quality companies, world-class assets that have at least a decade of growth ahead of them, that I think they'll continue to grow their revenues for the next decade, and I think they're at reasonable valuations. So that's my thoughts for now. I hope you guys enjoyed my little impromptu update, and I hope you have a wonderful weekend.